The charity itself, that is highly regulated by the Department of Insurance. Like I said, the charity has to set up reserve accounts, and they just can't pick out a number. The Department of Insurance specifies how much is set up. They also specify that the charity must pledge all of its assets to, I guess it's just like a bond, okay? Must pledge its assets to meet those obligations.
So St. Joe would have to sell all of its hospital buildings, etc. It could be completely, totally broke, have no assets whatsoever before they have to stop paying that annuity.
Yeah. Mm-hmm. Thank you. But it's a good question, which begs to, and the Department of Insurance has certain guidelines before they'll even issue a gift annuity. Most of the time, the charity has to be in existence for at least 10 years. They have to be able to substantiate that they're a good, solid organization.
Yeah, but you don't see the smaller charities have a gift annuity program. You would go through a community foundation if you wanted to benefit a smaller charity. Do you allow at St. Joe's, let's say, if I wanted to give 30% to the YMCA and I wanted to give 70% to St. Joe's, will you write that entire contract?
But the question that Peter is posing, that with the gift annuity, where we basically are controlling it, and if someone said to us, I'd like to be able to give it to St. Joe, but would you agree to also give, say, 30% of it to the YMCA or whatever other charity? We do not do that. However, I believe the Orange County Community Foundation does have that type of an environment where you can get the annuity, everything that I just talked about here, and then you say, well, I would like to be able to support 2 or 3 different organizations. So in that scenario, you would have a little bit more flexibility. But some charities will do that. I think the overwhelming majority of them they do not, with the exception of your community foundations. Good questions, though. All right, so we're still in this arena. Very deep water of charitable trust. We've got control. We've got issues as far as, do I want to have the income subject to fluctuation? Do I want to have guaranteed income with the annuity trust, knowing also that this stands on its own? As I said, the big difference between a gift annuity and a charitable trust is that you do have that gift annuity, that charity involved in this scenario. With the charitable remainder trust, you've got the trust. Here, everything, you poured it into there. It's just like you have your living trust here, okay? And then right next to it, you have a charitable remainder trust. All right? So the charity isn't involved. You're involved. You're managing this during the lifetime of this trust. So a lot of issues, a lot of things that you have to be careful of. But let's talk about other possible ideas, because that's the whole thing. Because I want to talk about the give it twice trust. Oh, I like that. I can give something twice. And again, we're using these tools and applying them to a situation. Many times, people will say, you know what? When I die, I don't want to give everything to Sally and Billy, all right? They're okay, they're good, but they just, they're still, I'm not comfortable with it. So I'll say to them, well, did you have any idea of giving them some type of a lump sum? And they'll say, maybe, $50,000, $100,000, but, I just don't want to give them $1 million. And then I'll say, well, what would you think about an arrangement whereby they would receive income for, say, 15 years, maybe 20 years? And then at the end of that time, you would also make a gift to charity. You would give it twice. You would give the income to your children during that period of time, and at the end of that period of time, it then goes to charity. Well, that is an annuity trust. So people don't buy, or they don't create a charitable remainder trust. They create a trust that helps them solve a problem. The most important thing for an advisor to know is, what is it that you're trying to accomplish? Tell me what you're trying to accomplish, and we'll look at some ways it can be facilitated, rather than saying, you need this, or you need that. Well, I don't know what you need until I understand what you're trying to accomplish. But these are tools that you may not have ever heard about. They're there, they do work, And in the right situation, they are powerful. They are very powerful. It just depends upon the situation. So again, we have the Give It Twice Trust, just a quick overview. And we haven't, like I said, I could spend an hour on this alone as far as all the shades and the colors and different ways and different applications. Just remember, you're talking about the transfer of assets, either during your lifetime or at death. And so from an estate planning perspective, this type of a trust can be very powerful because you're saying, all right, Johnny and Susie, I love you, but I just have some concerns and I want to provide an income for you. I know with my one daughter, she's attention deficit, she's a bipolar, and she's got good control of it, but I just wouldn't feel comfortable in giving her everything. So every family is different. Every situation is different. The size of your estate, the composition of your family, everything is different. I wanted to make sure that at the end of this session, you have a better understanding of another component that you may not have been aware of. And I also want you to feel comfortable that you have a resource, the website. You say, well, gee, he blew through that stuff awful fast. And yes, I did, by design. We just can't go into detail. But you do have a resource of being able to go there, and you can check with Peter. You can check with your advisors to say.
Most advisors don't know this.
And that's true. Yeah.
They really don't.
Yeah.
CPAs don't. Financial advisors don't. Brokers definitely don't, because there's no commission or fees involved.
Yeah.
So a lot of professionals don't have a clue.
Yeah, and it's right. I've been in Orange County for 25 years. A fair amount of my work is with professional advisors. And what Peter says is true, and it's unfortunate. I'm a firm believer that anyone who is in the professional advisory services needs to give their clients all of the options. And if they don't understand them, they're not doing their job well. They don't have to know all of the particulars about it, but they should know that it's there, so that when you're looking at the big picture, is a charitable component something that's feasible? Well, if the advisor doesn't know anything about it, he or she isn't going to put it on the table. And I think that is unfair to the end user, to the client.
An advisor never is wrong when they say no.
Yeah.
So I agree with, and I echo his comments that, and it's a delicate balance, because when I'm talking to the professional advisor and someone who is a friend of the hospital says, Jim, I wanted to talk about this and do this and this, and then we get involved with the attorney or the CPA or whatever the case may be, and they're not totally up to speed with it, it's another process to bring them, because you don't want to in any way ruffle their feathers. It's somewhat of a diplomacy 101. But the bottom line is the individual. The individual. And the most important thing is for them to understand what it is that they want to accomplish and the tools that are out there. I just planted some new stuff in my garden, and I used the right tools for it. Okay, I used explosives to get through the clay. All right, we're going one step deeper. Yes, sir.
Sorry, I've got to go backwards.
That's okay. That's okay.
Okay. I want to go back to Ellen Kelly.
Okay.
The Home Plus annuity.
Yeah.
All right. And in that case, she has a tax deduction of $344,663.
Right.
What if she's only on a retirement income of $36,000?
Okay.
She owns this home, but that's all she's got.
Right.
That doesn't do her much good.
Well, I agree with you, because
saves her tax for 1 year.
all right, now hold on one second here. So what we have here, now don't forget, we did have an income tax deduction of, let me just get it. Yeah, that's true. But now we've increased her income by $48,000. So she might be in a taxable situation. You bring up a guy.
Is it in the year of the gift plus 5 years?
Yeah.
Got 5 years?
Yes. No. Total is 6.
It's 6.
Gift. The year of the gift plus 5. Thank you for bringing that up, because again, when you're talking, that's the fine tuning. But yes, you might have a situation, even in a situation like this, where they may not be able to use that deduction over the 6 years. But I can tell you one thing, in this particular case, she has $48,000 more of income than she had the last year. So it's a good situation, but you bring up a very good point is, okay, we've got an income tax deduction here, but remember what I said before, if she just stopped at making the life estate, remember I said part of it what she could do, because it's basically 2 gifts. The first gift is called the life estate. And if she just stopped there, she would have a huge income tax deduction. And if she's in a relatively, because why is she doing it in the first place? She wants to get more income. So she probably doesn't have enough income to justify a $500,000 income tax deduction. She can't use it. But what we do is we take that income tax deduction and then we fund the annuity, but we still have an income tax deduction, but now we have more income.
I didn't think about the additional income.
Oh, I do all the time.
Yeah.
I would be if I-
Yeah, but no. This is complex, and like I said, there's a lot of moving parts.
No, and it's a great point.
Yeah, it is.
The thing about these gift illustrations, if it turns out, let's say for instance her income wasn't, and the tax deduction wasn't any good for her,
Yeah.
then from a financial end, this may not be the best
Yeah.
thing for
Yeah.
her.
Yeah, you bring up
But you don't know that until
Yeah.
you get into the kind of the nitty gritty. And that's why Jim really isn't a salesperson, because he's not there, even if there's no income tax deduction and your goal was an income tax deduction, that is the worst situation to talk somebody into.
Yeah.
So that's why you gotta have these illustrations. They don't happen in a day.
No,
It
no.
takes months
Yeah.
for somebody to go through the process, understand it.
Whoops.
I mean, these things are complex.
I'll give you a great case in point in terms of the complexity. I'm dealing with a family, been very, very, very successful in real estate. He's probably 83 now, and been working with him for 8 years. Delightful person, but the issue he had was he didn't think that he thought he was immortal. Okay, just a lot of people are that way. He's very active. He's very engaged in the business. A very spry and healthy person, and he also kept on waiting for the taxes. He felt that the estate taxes would eventually be totally eliminated. So we got together for breakfast about a month ago. And I said, okay. And his son is there. A couple of things I want to... Oh, another thing that's very important to this whole scenario. The daughter-in-law, whose father was very successful as well, died last year. And she's now running the business. It was not good planning. This fella... 2 things really struck a chord with him now, okay? I said, listen, here's the deal. You can shelter $5 million. Your wife can shelter $5 million. How much above that are we talking about? And he just looked at me, and I had a pretty good idea. And he says, well, it's substantial. And I know he's probably somewhere in 80 to 100 million, depending upon the value of real estate. Huge estate. He's, like I said, 82, 83. And he also, I says, you also realize that that's what you can do for taxes, and you ain't going to be out. You ain't going to be here for the rest of the year. You know, you're. And I knew this from talking to the son. The impact of having his friend die, because they were contemporaries. It's taken all this time to come to realization. And we're talking about not only what we've just talked about, but the next thing. So that's a beautiful segue into this next type of a planning technique, which is pretty good timing. But it is about the right timing, the right situation. And some people, they drag their feet for whatever reason. I might step on a few toes. Are there any engineers?
You can step on an engineer.
Engineers are tough, and you know, and real estate people are tough because they're always doing a deal. They're always doing a deal.
Can't read enough.